own bonds? Raise your hand again. Raise your hands high if you own bonds. Okay, now keep your hand up if you actually have the bond itself, the piece of paper. A couple of you do. You have the bonds. Typically, when you go out and buy bonds, just like if you buy stock, you don't actually take possession of the bonds themselves. You'll leave the bond in the street name of the brokerage firm that you use to buy the bonds. But sometimes you will take physical possession, and again, the bond will state what the face value is, what the contract rate of interest is, what the maturity date is. Now, this contract rate is the rate that that bond pays. We're going to compare that with the interest rate that exists in the marketplace on that date. We're thinking about buying a bond that has a 5% contract rate. Well, is that a good bond or a bad bond? You compare it with what all the other companies are paying now with their bonds, the market rate of interest. That market rate or yield is also going to come into play when we try to find the present value of a bond's future cash flows. We'll do that pretty soon. And then finally, this term leverage. Leverage basically just means using somebody else's money to make money for you. I think I talked to you about, a couple chapters ago, I asked you if 10% was a good rate of return. Some of you raised your hand and said yes, some raised your hand and said no. And we decided that it depends on what you're paying to acquire money that you would then invest at 10%. Leverage is a tool that can work for you or against you. If you can borrow money and then take it and earn more than you're paying to the lender on that borrowed money, leverage works for you. On the other hand, if you borrow money and you invest it and get a lower rate of return than what you owe to the lender, leverage works against you. It's just a tool. It's not necessarily good or bad, but a tool. One thing is for certain, the more leverage you take on, the more debt you use, the more risk you're going to have. You can't go bankrupt if you don't borrow money. You have no bankruptcy risk if you have no debt. The more debt you have, the more leverage you have, the more chance you have of going bankrupt. And so again, leverage is a tool, and it comes at a little extra risk in terms of bankruptcy. Now I'm going to show you some numbers that have been generated in order to result in a positive use of leverage. The numbers are such that in the end we're going to say this was great use of leverage. The company did a good thing by borrowing money. But again, leverage can work against you as well. But here's how it might work for you. Here's what's going on right now with this company. They've got $100,000 of profit before any interest expense and income taxes. It looks like they have no interest expense, meaning they've got no interest paying debt right now at all. So all $100,000 flows to income before taxes. Looks like their tax rate is 40% because the tax expense is $40,000 of the $100,000, leaving them with $60,000 of net income. Currently, they've got $10,000 shares of stock outstanding. So the stock that is in the hands of the owners, 10,000 shares. Therefore, we can calculate this number called earnings per share. That's the net income divided by the number of shares. The owners can then look at that and say, for every share that I own, the company made $6 in profit. The company wants to expand, wants to grow. Maybe build a new factory or something like that. In order to do that, it needs money. It's got choices. It can either borrow the money by issuing bonds, or it can have new owners come in and join the business and contribute some stock financing. Well, let's take a look at the bond financing first. If they borrow the money and they grow, the profits will go from 100 to 150 before interest and taxes. Because they borrowed money, they now have interest expense, 30,000, let's say. That'll leave 120 for income before taxes. Take out 40% for tax expense, and they're left with $72,000 in profit. That's better than what they had. But let's stop here and go over and look at the stock financing. If they use stock financing, they grow. Profits to $150,000 before interest and taxes. Again, if they use stock financing, there's no debt there, so there's no interest expense. We've got $150,000 before taxes. Take out 40% of that in tax expense, leaving $90,000 for net income. So right now, if that's all you look at, you'd say, well, it's a no-brainer. They should have gone with stock financing. But if you go with debt financing, you don't have any new owners that you have to share the profit with. You've got more profit, same number of owners, so the earnings per share for the owners went from 6 to 7.20. On the other hand, if you go with stock financing, that means you got new owners that came in to join your business. More partners to share the profit with. And even though the profit went up, even higher than it would have with bond financing, since you've got so many more owners you're sharing the profit with, the earnings per share could actually go down. Once again, the numbers here were rigged to result in a conclusion that leverage was good. In this case, leverage turned out really well. It doesn't always turn out that well. What you have to remember is, if you're going to borrow money, you better be able to take that money and earn a greater rate of return than you're paying to the lender. Any questions about leverage? Okay. This gets into some of the basic concepts of what determines the value of a bond. Let's take a look at the top panel first. Company A wants to borrow money by issuing bonds. They start discussing what interest rate to put on their bonds, the contract rate, coupon rate. And they decided that they want to put an interest rate on their bonds of 6%. That's the rate of interest they will pay the bondholders whenever they issue the bonds. But they have to go out and find some investment banking firm that will help them sell these bonds. So maybe they contact J.P. Morgan. And they say, we want to borrow $1 billion by issuing these bonds. We've decided that we want the interest rate to be 6%. Will you help us sell these bonds to borrow the money? And so they go through some contract negotiations, and eventually they say, okay, today's the day we're going to sell the bonds. If, on the day they sell the bonds, the interest rates have gone up to 10%. People are going to look at Company A's bonds and say, 6%? And they'll look around and they'll look at all the other companies that are paying 10%. And they're going to say, I don't think I like Company A's bonds all that much. They don't pay as much interest as everybody else. Therefore, the only way Company A is going to get people to buy their bonds is to lower the price. People are not going to want to pay $1,000 for Company A's bonds that give them 6% when they can go out and buy other companies' bonds for $1,000 and give them 10%. So in order to get Company A's bonds sold, they'll have to lower the price. $900, $800, $700. At some point, investors will say, okay, we've lowered the price enough to entice me to go ahead and buy your bonds. If bonds sell for less than their face value, they're said to be sold at a discount. And again, the discount will be because the contract rate of that company's bonds is less than the market rate. Well, the opposite could happen too. Here you've got Company B deciding they want to borrow money by issuing bonds. They decided to put a contract rate of 8% on their bonds. They go through all the final negotiations with the investment banker to sell those bonds, and by then, market rates might have fallen to 5. Now, everybody's going to flock to Company B bonds and want to buy them because their interest rate, the contract rate, is better than all the other companies' bonds at the time. Company B knows that. They're going to know that everybody's going to want their bonds. And so what they're going to do is they're going to raise the price. $1,100, $1,200, $1,300. At some point, they will have a number that will entice them to want to sell the bonds. And if they sell them for more than face value, they're said to be sold for a premium. And once again, the premium will be because the contract rate is greater than the market rate at the time. Any question about that? Basically, if you want to be a good bond investor, you need to have a great understanding of interest rates and what will cause them to change in the future. You all probably know that in the last 3, 4, 5 years, interest rates have been coming down. That makes bond prices go up. Think about the time value of money that we talked about 2 chapters ago. When discount rates go down, present values go up. So what you need to do if you want to be a good bond investor is say, if I buy a bond today, what's going to happen to interest rates tomorrow, next week, next year, and 10 years from now? If you believe interest rates are going to go down in the future, and you bought a bond today, when interest rates go down in the future, your bond investment will go up. On the other hand, if you buy bonds today and the interest rates in the future go up, the bond value is going to go down. You'll be losing money. So your chore as a bond investor primarily is to be able to predict future interest rates. A lot easier said than done. Now, when it comes to bond problems that we have for you, there are 3 different kinds of bond problems. We're going to talk about 2 of them today. This is the first type. It's the easiest type of bond problem as well. This problem says, on June 1st, 2009, Deuce Company issued $10,000 face value, 10-year, 6% bonds, paying interest semi-annually on May 31st and November 30th. First of all, when you see the description of the bonds up here, $10,000 face value, 10-year, that means when the maturity date is, 10 years from now. The interest rate that is in that part of the sentence, that's the contract rate. This is the interest rate that Deuce Company bonds will pay, and it's an annual rate. They're going to pay 6% of $10,000 every year. However, they're going to pay this twice a year. So instead of 6% once a year, they're going to pay 3% twice a year. Then it goes on to say the market rate on that date was 6%. So everybody else is paying the same rate on their bonds as the Deuce Company is. When that happens, the company's bonds will sell at face value. They're not going to sell at a discount. They're not going to sell for a premium. They're going to sell right at face value. Then it goes on to say that the company's year end is December 31st. Here's what we want you to do in a problem like this. Record, that means what accounts are affected and how. When the bonds are sold, the first interest payment date, and then at the end of their fiscal year. First of all, remember I told you, if the contract rate and the market rate are the same, the bonds will sell for their face value. That means the company's going to get cash, and they're going to have a liability of the face value, $10,000. Anytime you see the contract rate and the market rate the same, the company is borrowing $10,000. That's what the investors are going to pay for the bonds. So there's $10,000 more in cash for Deuce Company, and they've got a $10,000 liability called bonds paid. Then, remember when this happened? This was June 1st. 6 months later, it's November 30th. They have to make their first interest payment. The interest payment is going to be $10,000 times 6% divided by 2. Remember, this is going to be $600 a year, but they're making payments twice a year. So they're going to pay $300, and that $300 is also showing up as interest expense. Semi-annual payments. Then, the last thing we've got, after November 30th, 1 month goes by, and it's the end of the year for the company. At the end of the year, they want to close their books and prepare a balance sheet and an income statement and a statement of cash flows. At the end of that year, they have to be able to report 1 more month has gone by, so we have to record 1 more month of interest expense. We paid the interest payment a month ago on November 30th, but since then we've got another month that's gone by. Another month means another month of interest expense. So they're going to show at the end of December, 10,000 times 6% divided by 12 or multiplied by 1/12. In other words, we want 1 month worth of interest expense. And since we don't have to pay it, we're paying the interest every November and May. We're not going to pay any interest, but we have to record the extra interest expense that's built up since the end of November. So that extra month of interest is called interest payable as well. This is interest that we're going to have to pay down the road. We've got some calculations down here to show where these numbers are coming from. But at the end of December, this is 1 month more of interest expense, and it's also showing up as interest payable. Because we don't make payments until May 31st and November 30th. Record when the bonds were issued, how much cash did they get, what's the liability. Record what happens on the interest payment dates, and be able to record this adjusting entry at the end of their year to show how much interest has built up since the last time they paid interest. Any questions about anything you see up there? Any questions at all? Now, typically, I get an ambitious student who will ask, well, what are they going to do next May?